Welcome to Secret Sauce, the show where we hear real-time insights from industry leaders. I'm Karly.iacono, Senior Vice President at CBRE. And today I am pleased to be joined by Mary Cunningham, the CEO of Chicago Deferred Exchange. Mary, what a pleasure. Thank you so much for joining us. How are you today?
Good morning, Karly. Thank you. I'm doing well. Thanks for having me on this morning. I appreciate it.
Excellent. So 1031 exchanges are something that are near and dear to my heart. It's a huge driver of business and one of the most important pieces of the commercial real estate industry in my mind. Really keeps things moving forward. So we're excited to have you here today to learn more about the exchange process, some hangups and some tips for all of our listeners. But before we dive in, why don't you give us a quick background on Chicago Deferred and your role as CEO?
Sure. Thank you. Yeah. So again, I'm with Chicago Deferred Exchange Company. I'm the CEO. I've been with CDEC, as we're called, for over 30 years. And my team here in Chicago, as well as in New York and California, we work on transactions helping investors across the country to facilitate their tax-deferred exchanges. So CDEC is owned by Wintrust Financial Corporation, which is a Chicago-based financial services company. So we have a really nice big bank that stands behind us and helps our clients with the process.
So let's jump into 1031 exchanges. The basic mechanics, I think most of our listeners understand, but there's a lot more nuance to completing an exchange than most people realize. So why don't we kick it off with 3 things that you think clients often misunderstand?
Sure thing. I think one of the most common misperceptions is if you sell a multifamily property to get the like-kind exchange treatment under 1031, you have to also acquire multifamily property, and that's just not the case.
Right.
The like-kind standard is very broad. If you sell multifamily, you can invest in office or industrial or farmland. It doesn't mean you have to stay in the same sector of real estate. The other thing is that 1031 is not an all or nothing proposition. So sometimes you have an investor who wants to take some cash out, and that's completely viable transaction. As long as the numbers make sense, you can do a partially tax-deferred exchange where you take some cash out, you trade down in value, but you still get some benefit of the tax deferral. The third thing I would say that we struggle with our clients is helping them understand the restrictions on their ability to access their proceeds once they've entered into the exchange. So let's say you sell an investment property in New York and you identify 2 potential replacement properties within the 45-day window. And maybe on day 90, you decide that neither of those properties are viable options any longer. The way the 1031 regs are written, the QI cannot release the proceeds back to you until day 181, after the end of the exchange period. So it's really important. We talk to our clients a lot before they identify properties, so they understand those potential restrictions might mean their funds are tied up and not available to them, even if they end up having a taxable sale.
I think number 3 is probably the one that I see misunderstood the most. The like kind is something we cover in the first conversation, right? You don't have to buy. Often it is a transition to a different asset class. So clients will sell apartments and move into net lease. It's a very standard flow of capital.
Yes.
And then the partial exchange is a great point too. I'm glad you brought that up, that it's not all or nothing. You can take some money off the table. You can do full exchange, partial exchange. There's a lot of options there. But the third one, I don't see talked about as much. So I'm very happy that you highlighted that there are timelines that under which you have to hold the funds and they cannot be released the next day if someone chooses not to execute the full exchange.
Absolutely right.
So thank you for that. And just to dive into that last point a little bit further, can you get any of the funds back? Or what are anything that you're holding as the QI has to be held into that final day?
Yes. So, I mean, generally correct. Let's say you're selling a property for $1 million and you know you want to take $100,000 out. At the closing on the sale of the relinquished property, you can pull that cash out at that point. But once the funds get deposited with the qualified intermediary, they are subject to those very specific restrictions. So if you sell your $1 million property and all of the cash goes into the QI account, you cannot have that cash back until either you've acquired all of the properties that you've identified or the end of the exchange period. Or maybe you don't identify property and on day 46, you get your money back and you just have a taxable sale.
Right. So whatever way you're structuring it, whenever the exchange is concluded is when you get the remainder funds released from the QI.
Correct. If you've identified property and decide later you just can't close on one or more of them. That's right.
Right. Very interesting. We get a lot of questions surrounding ownership structures. So can you take a minute and touch on what types of ownership structures are viable for exchanges and if there are any that are not?
Sure. It's a great question. Really, any entity, LLC, corporation, partnership, individual, can sell property and buy property in a 1031 exchange. What is key, what is critical, is that the same tax-paying entity that sells the relinquished property needs to also acquire the replacement property. So certainly a corporation can sell property that it owns and buy new property as long as it's acquired in the name of that same corporation. Same thing with the partnership or an LLC that owns property. But as you know, a lot of real estate is owned by partnerships, and sometimes the partners have different objectives. Sometimes some of them want to exchange and some of them want to sell for cash, and then you get into the complication of who is the taxpayer in the transaction, and that taxpayer needs to be the same party that buys the replacement property.
So if we have clients that want to go different ways, which is pretty common, as you know, partnerships don't always work out like people hope. So if two partners want to separate and they own the property in an LLC, let's choose the, in my opinion, most simplistic scenario.
Sure.
What are their options? And when should they come to you and their attorney to structure the exchange? Can this be done 2 days before closing, or what's really the right time frame to start digging into your ownership structure and plans for the exchange?
Great question. And it is one of the most common issues we see as well. There's a couple of options. First, they can consider what we call the drop and swap, where the partnership itself terminates and deeds the property out to the two partners. So they are now co-tenants, co-tenancy owners of the property. And then the one now co-tenant who wants to do the exchange can sell their interest and buy replacement property in their own name. The other party can sell for cash and go on their merry way. The risk of doing the drop and swap is that once that partnership is terminated and the parties hold the property as co-tenants, essentially for 1031 purposes, your holding period sort of resets. So if you and I owned property together, Karly, and we deeded it out in a partnership, and we deeded it out today to each of us as co-tenants, and then we closed on our sale tomorrow. Let's say you wanted to exchange, I was selling for cash. If you were to get audited, it's likely that the IRS would conclude that you were holding that property, your interest as a co-tenant, primarily for sale and not for investment, which is sort of the cornerstone of 1031. It has to be property you've held for investment or for use in a trade or business. So the drop and swaps we do see happen. Often they do happen shortly before closing. If the property is encumbered, the lender is not going to be thrilled about you taking the property out of that partnership, which is probably also a special purpose entity that has specific limitations on the partners to do certain things that make the lender happy, right? So you want to do the drop mostly ideally in a tax world, you would want to do the drop in the tax year prior to the year in which you're doing the sale. In practice, I would say that doesn't happen very often.
Right. So we have the perfect scenario, to everyone listening, more time is better. Call Mary, call your tax attorney, and get this situated in the tax year prior, if you can. I almost never see that happen. Usually people come to us right before their downlink property is going to close and say, we need help with our exchange. It's closing in 2 weeks and we don't want to invest with our current partner. What do we do?
Right.
So there are solutions, it sounds like, and we've structured quite a few with the help of QIs and attorneys as well. But the closer you get to closing, sort of the more gray that becomes. Am I hearing you right?
I think that's exactly right. Yeah. And again, the risk is that you might be deemed to have only held that interest primarily for sale. The other thing you could think about is, if you and I were partners again in our partnership and you wanted to do an exchange and I wanted to sell for cash, you could tick out my interest to me as a co-tenant and bring into the partnership a new minority partner, say your sister or your friend. And that way, the partnership itself is doing the exchange. So the taxpaying entity in this situation has not changed. It's still the partnership that's doing the exchange. It's a little bit more complicated. It does cover certain sort of partnership tax law issues that are a little beyond my pay grade, but it's also an option.
I love that. And I think that the most important takeaway here is that there are solutions that you're not going to find if you're just Googling, how do I execute a 1031 exchange? This is really a much more complex process, or could be, than people realize. So the key takeaway here is to reach out to professionals like yourself early and make sure you have the right structure, because there are solutions. And the more time you have, the more variety of solutions, the clearer paths are available. But that's great. I hadn't heard the tick structure underneath the partnership. So thank you for bringing that up. Very interesting.
Sure.
If anyone listening is going, what in the world are they talking about? That's okay too, right? There's very simplistic 1031 exchange rules. And what we're touching on now are just more complicated changes to ownership structures. So this may not apply to you. And if you have a straightforward LLC, selling a property, buying another one, then it's a much more straightforward process. Let's switch gears for a minute, Mary, and talk about legislation. So we follow, and I know you do too, the political side of 1031 exchanges very carefully, because there have been many scares the last few 5-10 years, really, that 1031 exchanges were going to go away. Have you seen anything in the last year that gives you pause, or anything kind of coming down the pike that might affect 1031 exchanges from a political standpoint?
Yes, sadly, yes.
Oh,
We always have a target. I know, I'm sorry. We do always have a target on our back. We've gotten thrown into this group of loopholes along with a couple of other things. But so the Biden administration's 2024 budget proposes to cap the amount of tax that could be deferred using a like-kind exchange to $500,000 for an individual, or $1 million for a married couple filing jointly. This is the second year in a row they've included that language in their budget. And honestly, Karly, just yesterday, the Washington Post had an article about the discussions between the White House and the Republicans surrounding the debt ceiling, the fight that's going on right now.
Of course.
The Post mentioned that the administration wanted to include the repeal of certain tax loopholes, including a loophole that allows investors to swap properties on a tax-deferred basis. So, yes, it's out there. It's always out there.
It's always floating around.
Yes.
We've emerged unscathed thus far, but that's unfortunate that it seems to be coming back up. Now, that last proposal you just mentioned, that's $500,000 of sale or $500,000 of gain. What are the barometers again?
Yeah, it's $500,000 of deferred tax.
Okay.
So for an individual, or $1 million of tax deferred for a married couple filing jointly.
And are you seeing any delayed time frames under which that would go into practice, or would it be just with 24? So the beginning of next year it would hit.
Yeah, so it's the provision in the budget is very non-specific as far as that goes. Also doesn't address how you would deal with a partnership or a corporate entity that owned property and was doing a like-kind exchange. It really just focuses on the individuals. Our goal, of course, is to never have that implemented. So don't even want to know what those provisions would be.
Okay. So we're going to keep a close eye on it, and also hope that this is more of the same from the last 5 years, that it gets brought up and then kind of quietly goes away. So fingers crossed, but please do keep us posted with any new advancements, because we know you're watching closely.
Yes.
All right. Give us a common myth about the field overall, maybe about the world of QIs, something you hear day after day. What's something that's widely believed that just isn't true?
Let's see, a myth. So I would say this, that, barriers to entry into this field are pretty low. And I think a lot of people believe that the QI service is pretty commoditized. But I would argue that a lot of the professionals in this space have an immense amount of knowledge and expertise. And sometimes you need that as compared to maybe just the low-cost provider. As we've been talking about, some of these transactions can be very complex. So, I guess I would say that not all QIs are created equal, and I would suggest that people do their due diligence, ask a lot of hard questions when they're interviewing a QI. Don't just focus on the fee.
I absolutely agree with that, because it is looked at sometimes as just a okay, let's find this firm, let's send in our paperwork, check a box, and that's it. But there, as we've already been talking about in this episode, so much more to it. Tax savings, ways to protect liability moving forward, different structuring options. So do your due diligence is a great piece of advice. There's definitely more to it. And just on a basic level, I would add, for those of you who've never executed a 1031 exchange, the QI cannot be your attorney, your broker, your friend, your accountant. This is a whole specific industry, going back to square one, of qualified intermediaries. So make sure that you are kind of making this piece part of your overall transaction team early on, because it is a completely separate provider. Last thing I'll ask you, just on the company structure, Mary, what happens to the money when you're holding it during an exchange? How do clients know that their money is safe?
It's an excellent question and an important one as well. So there are a couple of options that are available via the Treasury regulations that a QI can use. You can use a bank account or an escrow account or a trust account to hold the taxpayers' proceeds pending redeployment into replacement property. At CDEC, we've always used a trust arrangement. So our clients' funds, when they're held in trust, are segregated and protected in the event of our bankruptcy, for example, and even in the event of the bank being seized by the FDIC. Like, we've seen a few banks fail in the last month or so, right? Funds that are held in trust at a bank are not liabilities of the bank like a deposit is. I mean, there was talk about depositors losing their money when Silicon Valley Bank failed, for example. Thankfully, none of them did lose their money because the government stepped in. But what the trust structure does, it eliminates that whole possibility that the funds could become part of, a seized bank's assets. It's a very important question. Thanks for asking.
Absolutely, and thank you for sharing that. And I think this is crucial, given not only just the recent bank failures, it's always been important, but now even more than ever. So thank you for sharing that background. I think everyone really would like the peace of mind to know that their funds are safe. Very important.
For sure.
Before we wrap up, any other advice or challenge you're facing in your business that you'd like to share? Anything else you'd like to put forth today?
Sure. Just a couple things. One, I would say we spend a lot of time educating our clients about the intricacies of Section 1031, but we are just one member of their larger team that includes their broker, their accountant, their lawyer. And so we try to encourage our clients to always keep us on the team, but make sure, since we're only seeing one part of the puzzle, make sure the other parties on the team know what's going on so that you get the tax deferral you're seeking. Make sure it's worth it. I think that's the biggest thing. Just keep, as you said a minute ago, keep your professionals close, ask for information and advice early and often. Don't take too much risk.
All good. All good advice. Excellent. Thank you so much for sharing those intricacies of the 1031 exchange process. For everyone listening, there are multiple iterations of 1031 exchange, deferred. There's 1033 exchanges. There's a lot more to this. We sort of just brushed on the basic 1031 exchanges and some things to keep in mind. So if you'd like to dive in deeper, reach out to myself, reach out to Mary. We're happy to help you for whatever your individual situation might be. Mary, it was great to have you on. We really appreciate your time. Thank you so much for joining us.
Thank you, Karly. It was really nice to see you.
And for everyone listening, that was Secret Sauce. We're so happy you could tune in, and we will see you again very soon. Have a great day, everyone.